The thoughts at halfway point of 2023. Again, not the true halfway point, but by the count of Standard Options Expiration Dates. So it's been a pretty good year, hasn't it? This is the year to date for SPY. Now, I could have pulled up QQQ, I could have put up DJX, but we're just going to use SPY for an example. I mean, just looking at the raw numbers, we started off around 380 there at the beginning of the year. And of course, we're flirted with 445. Now we're back down to about 440 with a little pullback. But some dips and some unexpected runs, definitely not as bad as 2022. Not as bad, but was also good that we saw in 2020 as well. We started off the year with concerns, of course, of more interest rate hikes. Inflation was still key and still on our minds. Global conflict still going on and entering well past, closing in on a year. And of course, different global economies having different global issues. Well, we've seen a good bullish move to begin the year. Starting off in January, we saw a good run. We had many conversations on covered calls and naked puts. We opened some good positions in the married put portfolio at the start of the year, ending in December and moving into January. And we had some discussions on our Fridays about getting back into bullish spreads, calendar call spreads, sectors and industries that were looking hot that might be a good idea for those kind of maybe longer term bullish strategies. And of course, as always, the management. With those structures of covered calls, when the market was doing well in that beginning point in January, we had questions about how to roll and adjust covered calls that were now in the money. How can I get more return? We focused on using the portfolio tools and PowerOptions to show the rollout opportunities and other ideas. But of course, we had other questions adjusting bearish positions in iron condors that were entering the loss range as the markets continued to move up at the beginning of the year. Adjusting winning and losing both long call positions and long put trades. I had some discussions on managing losing long calls where the stock fell out of bed. The market was moving up, but some news came out, the stock fell out of bed, and there we were. And then we started to see the first warnings, sell warnings of the market sentiment tool on PowerOptions appearing in February. The market began to pull back around the 19th, finishing the worst recent week, ending February 23rd. And the cause, of course, that inflation and that economy roared its head again. Inflation gauges were coming in hotter than expected, which we could have expected, those of us that were out doing grocery shopping, doing purchases, the interest rates and everything, the home buying market. We could see that coming, that it was probably going to have a glitch in the system somewhere. So what are we looking at here? Well, this was the market sentiment tool. We're looking at the history back on that time frame on February 7th, February 2nd, February 3rd. It was right about in this range here I'm sorry, I think it was over here. I cut out the date on this one. I apologize. I think that was over here. We started to see those sell warnings. Yeah, at about the 4160 is moving up here. We're starting to see those sell warnings in that case. And so that was an indicator that, hey, we might want to start lightening up on some of our bullish positions. Might want to add some insurance to our portfolio. Maybe VIX calls, maybe puts on SPY, maybe things of that nature. Lighten up some of the leverage bullish trades or maybe close them out if we're at a profit on those positions. Maybe sell some premium against the stocks or our covered calls there to generate a little bit more income. Shortly after that, we did see an attempt to recover. We saw the sell warnings around 2.5 and 2.12, and we saw the market dip. I'm going to change this pen color here to make it a little bit more clear for us. Fantastic. So we get the sell warnings, and then we start to see that dip I mentioned, February 19th, and right around the 23rd here. That was that worst week that I was referring to, due, of course, to the inflation gauges coming in hotter than expected. And we started to see a little return, and then, whoop, right around 312, 313, mid-March, we dropped down into the doldrums. Why? Well, that was the bank crisis of mid-March. Should have been March. Now, it did follow bullish signals, but SLVB, trading halted on Western Alliance and other securities as well during that time frame. And when we thought we might start seeing a light of day, we started to take a beating, and then the buy signals really started to kick in and really started to work for us with a couple of little hiccups going into April. And some of that was due to recapitulation, moving out of different securities. Discussion, I remember seeing a couple articles on moving out of retail now that the banks had settled, but moving out of the brick and mortar retail, Home Depot, Lowe's, Walmart, things of that nature, and investors are starting to look more into leisure. Coming up in the summer, people want to get out. I want to get out. I'm sure you do too. But we want to get out, and the cruise lines, airlines, hotels, things of that nature. Of course, oil prices were fluctuating, so we're seeing some capitulation in those too. But the leaving of the banks, where is the money going to go? It started first going into those and leaving the retail and going into those. And then, of course, just in the past few weeks, we see that massive, large movement upwards, fueled, of course, by the interest rate pause, but most importantly, before that, one hell of a move in the AI stocks and some other tech securities that really buoyed up the market. NVIDIA, Rambus, AMD, one of the myriad puts I'm in, bought it at 96 earlier in the year, wrote it down to 86, never had less than a 5.5% loss on the position, I think. And then it rebounded back up to 110 with its earnings, then up to 130 with NVIDIA's earnings, up to 135. Now it's pulled back to 120. But I was able to bulletproof the position. I still have protection out to January, so we're looking really good on that myriad put in the Fusion portfolio with the right type of movement. But honestly, that was kind of my expectation at the beginning of the year when I got into AMD, was a target of 125, probably closer to March or April as opposed to May or June, but that's what we saw, and I will take it, and I'm in a great position there, following the rules in the blueprint. And this gave us something else, didn't it? This has given us levels in the VIX that we have not seen in some time, down in the 13 and 14 ranges for the past week or so. Of course, that's what prompted one of the questions that we got last week, and you can check out that presentation, as I mentioned earlier, the strategies for low volatility markets right there on the YouTube channel. But these are levels we have not seen in many years, and they've continued to drop. But I think we had a little pickup today, as, of course, we've seen a little bit movement as well. Now, of course, one thing I forgot to mention is as I'm showing the market sentiment tool and how it was followed over those different time frames, it hasn't updated yet. But when we go back to PowerOptions to answer some of our live questions that came in, we're going to see the update from June 16th. But as of June 15th, we were at a bearish sell warning. We're back down here as we were back on February 5th or so. The reason I bring that up, of course, is because this might bring us to a near-term hesitation or a near-term pullback after this nice strong run that we've seen, VIX at these lower levels. But again, expect to see the VIX had moved up today a little bit, had some easing off on the markets a little bit today as well. I don't know if it's going to be enough to turn that, so I'm expecting some bearish trends going forward. Now, what does the rest of the year have in store for us? Well, the unknown, I am sure. But I wanted to give these few slides to illustrate the benefits of both the market sentiment tool, didn't show using PowerOptions, but PowerOptions to track and manage your positions and evaluate rollout opportunities. And of course, let's not forget the proper structure and proper allocation. Towards the end of the year, I opened a Schwab position when it was at 82 as a married put following the rules in the blueprint. This was posted in the Fusion portfolio. We started off the position with about a 8% risk, 7.5%, I believe, percent risk on the trade. What you're not seeing here that I took out for size-wise is we did about 4 or 5 different adjustments, selling calls against the Schwab position, adjusting the put, near bulletproof the trade at one point, took it out of bulletproof status as it declined, but then it came right back up to where it was. I didn't want to move the put again to truly bulletproof it at that time, so I wanted to leave more upside profit. And as you can see, closed here on March 14th. And from the time I opened the trade to the time we closed it at 56.79, the stock was down 30.9%, but we only took a loss of 6%. I admit that should have only been about 1.5% or 2% had I moved my 80 put up sooner to back to the 82.5 or even the 85 strike. But I didn't want to take away, I should say, from some of the upside profits I had on the position. But lo and behold, the unexpected bank crisis happened, and there we were. I lost 6% on the Schwab position. I consider this a win. Because had I even been doing this as a covered call since I opened it on December 27th to when I closed it on 3/14, I still would have had close to a 24 to 26% loss on the trade. I evaluated that and back tested based on standard rules of using just at or slightly out of the money covered calls and having to roll them, rolling down, and then the mass decline in those positions. So I'm going to take that as a win, saving 24% of what I invested in the position because the proper structure of the married put. That's still going to be used for 50%, 60% of my total portfolio, as you all know, as you've all heard me say, going into the end of 2023, no matter what comes up. But real quick, I want to know your thoughts. Just a few quick polls on your initial expectations in 2023. Your returns, if you feel like telling us, but not your true returns, just where are you related to that in 2023? And what is your forward-looking sentiment? So let's go ahead, and I just want to launch the first poll here. What was your initial expectation in 2023? Well, better than 2022, we hoped. Well, I think we've seen that. Were you expecting a slightly bullish market, but hesitant? Were you expecting a mostly bearish with the economy as it was, interest rates, and other factors as well? Or do you think we were going to settle down and move back to a melt-up market similar to what we saw in 2021? I'm sure there's more answers. And of course, if you have another answer or expectation that you had, you could go ahead and send that to us in the question pod. I just want to leave this poll open for about a minute or so, get some answers there, get some ideas. Excuse me. All right, so we're going to leave it open for about another 10 or 15 seconds. Pretty much got a tie right now. And again, I mentioned this isn't every result we could possibly have, but just some of the ones I thought of. All right, so let's go ahead and close the poll, folks. I want to share the results real quick. As I mentioned, almost an even tie. 44% of you were slightly bullish on the market, but hesitant. 44% of you were mostly bearish with what we were seeing in the economy, interest rates, inflation, and other factors, global economics, global conflict, and everything else. And 11% thought that we'd go back to that melt-up, that calming that we saw in 2021, where we moved up gradually for a few weeks and had a little dip, and then moved up gradually and had a little dip. As we discussed last week, that's kind of the prime market that you want for those neutral strategies, iron condors, short strangles, not what I trade. We discussed that last week, maybe even some butterfly positions as well. Now, not sure which one of these is correct, so I'm going to use this one. How has your trading been so far in 2023? Not related to your initial expectation, but what you had looking forward. Did you exceed your goals so far in 2023? Are you on par with your trading goals? Are you profitable but behind your targets? Are you at break even? Or are you currently losing money in 2023? So I've had the poll open for about 45 seconds. I'm just going to leave it open for another 10 or 15 seconds. We've got some good response on this one. All right, let's go ahead and close that poll. 70% of the audience answered. That's fantastic. Thank you very much. Let's go ahead and share it with the rest of the audience, with everyone. 18% so far have exceeded your goals going into 2023. I'm not going to ask what the specific goals are, but we're going to go ahead with that. 9% are on par with your trading goals. I'm in that 9%, by the way. I haven't exceeded my goals because I've been gun shy as well. I've been more conservative. I didn't jump into bull put credit spreads when I should have. With that more 15 to 20% of my portfolio, I'm holding at about 7 to 9% of my portfolio. But yeah, I'm on par with my trading goals. 18% profitable, but you're behind your targets. Okay. And 27% of you are break even. Unfortunately, 27% are also losing money in 2023. Now, I just want to remind everyone, of course, for all levels of answer, any level here, especially those that are currently at break even, or those especially that are currently losing money, remember, you can email us to support@powerop.anytime. Send us your questions, send us your concerns, what strategies you're using, what's been working for you and not been working for you. Ernie and I can take a look at it. Of course, if you're a trial member or subscriber to Power Options, always remember you can schedule one of those free coaching sessions where you can take a look at what you've been doing in your first half of 2023, where things went wrong, maybe what management techniques did or did not work, what management techniques we might consider. So I encourage you to do that. And just one last one, and then we'll move on, I believe, to our live questions. And of course, what are your expectations for the rest of 2023? The way things have been going, you're expecting a slight pullback. Sort of after this long run, we've got to see a pullback, we've got to see a correction, and then back to bullish mode. Are you expecting an extended pullback, decline, and hesitation for a few months, if not more? Are you expecting hesitation and then high bullish, expect SPY to be above 480, or SPX we could say to be above 4,800 to close out the year? Or do you feel that we're going to exceed the negative expectations and SPY is going to close below 370 or 3,700 as we close out 2023? And I know we can never know, but this sort of goes hand in hand when we think about it, is what were our initial expectations? What has the market so far taught us in the first 6 months, knowing that the next 6 months are completely unknown, and even with our expectations, other things can happen. But if you had a certain expectation coming into the year and a certain target that we all have different targets, but the targets we had to profit, and if we're meeting those, great. If we weren't meeting those, then how are we going to meet those with this new expectation we have going forward for the remaining 6 months as well? And again, that's something that Ernie, myself, can help you with on the coaching sessions, email discussions, as well, or just general phone calls and general topics. All right, let's go ahead and close the poll and share it with everyone. And this is kind of what I expected, a mixed bag, but one sort of slight leader. It looks like 40% expect a slight pullback, a correction after this long run, and then back to bullish. 30% feel an extended pullback for a few months, if not more. 30% similar to the first one, I know, but hesitation, more direct, and then SPY closing out above 480 at the end of the year, or 4,800 for S&P 500. No one said exceed the negative. No one's really bearish here in our audience today, where they feel that SPY is going to close below 3,700 or so to wrap out 2023. I myself am in the 40%. I don't quite have that bullish outlook towards the end of the year being above 480 or 4,800. I'm going to be honest with you, but I do expect a slight pullback. Confidence in that, of course, is shown with the market sentiment tool that we showed a little while ago. And then, of course, moving back to bullish, maybe not as extreme as we've seen. We're going to need another catalyst like the AI, another sector industry to have really strong results that push the market up in the last, like we saw. Of course, we saw some other strong earnings come in. And as I mentioned, you're seeing some of those movements in the airlines as well as the cruise lines and others also with some hesitation, but they're showing really strong results as well over the past few weeks as people are going out and traveling. We're expecting better quarters going forward from the leisure industry and others. All right. Well, that was just what I wanted to talk about brief introduction. I know it was about 20 minutes or so. We got started a little bit late, started this around 4:40, 4:45 or so. It was 15 to 20 minutes, but it's always nice to do that check-in. And I always like to use the polls at this time so that you can help answer them yourselves, reminding yourself, hey, what were my initial expectations at the beginning of the year? Where am I right now as far as my goals were concerned? And if my expectations are this going forward, what can I do to make sure if my expectations are correct or even slightly correct, that I put myself in the strategies and at the advantage to take advantage of that and to start meeting my goals in the last 6 months. And of course, as I mentioned, as always, we're here to help you via email, via phone, through the coaching sessions for trial members and subscribers.